Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Thursday. It's September 15th. Do not ask me where September has gone. I actually thought yesterday we were still like in September 4th, 5th, 6th. Time is like running away from me. Now, the market's opening up a little bit. Well, actually, we don't know where it's going to open up. We got a big report coming out in a few minutes, and I'll be talking about the retail sales report. But so far, the market is on the lower end of the range. Now, again, when you see the Dow down 12 or 9 points and the Nasdaq's down 45 points, that's not significant. So this is really random in anticipation of today's data. The biggest factor you're going to have to keep your eye on, especially over the next few weeks, is the bond market. And by the way, folks, if I'm benefiting you, if you're enjoying these videos, if you're getting some value out of it, if you're getting some questions that you want to ask me, post your comments below these videos. I read each and every one of these comments every day. And believe it or not, I respond to every one of them. So post your comments below this video if you're watching on the YouTube channel. Thank you. So we're right now a little bit below our channel range. But as you can see here, we're holding up pretty good, or pretty well. I'll use proper English. And it does look like we're a little bit oversold in this territory. My guess would be that we're going to hover around here or possibly turn higher. And one of the reasons why I think that's the case is because consumer discretionary is actually holding up really well. I'm kind of surprised, but we're still above the previous resistance level, which is now, if we stay above here, becoming the short-term support. Also, if you look at StockFetcher, which I do all the time, my sector scan, consumer discretionary is now the fourth one. Even now, with all of this craziness, and technology starting to move up. Now, there's no question the market is fragmented, especially after the move we had 2 days ago. But based on what I'm seeing, I'm encouraged by the fact that the bond market is not cooling off as much as I thought. Now, in about 2 minutes, we're going to have the retail sales data. Now, just to show you what's on the table, we got jobless claims, we got manufacturing activity, we got retail sales, and then later on, we got import and exports, and later on, we got industrial production, which is also big. So we've got a lot of things hitting the table. Now, in my opinion, and based on everything I've learned in the last 28 years, the retail sales report is going to be the big one. And I mean the big one. Because think about it, retail sales makes up 2/3 of the economy. Now, look at this. Consensus is flat, ex-vehicles flat, and ex-vehicles and gas up a little bit. I'm really hoping that these numbers are a little bit beyond or a little bit above flat or 0.6, because if that's the case, it could give us a nice little rally, especially in consumer stocks that are looking for this right now. If we don't get a rally, if this number is really low, watch out below, because we could potentially break lower. But here's the thing, as long as we stay above this line, as long as we're above the 155 level on consumer discretionary, and as long as the bond market doesn't break lower, and when I mean lower, I mean, this type of trading range, as long as we kind of hover around here, I think we can get out of this, at least this downside for the time being. We may have an issue in the next couple of weeks, especially next week when the Fed raises rates. But for now, I think we're going to be in a wait-and-see mode. I think the market's had too much deceleration pressure. I mean, we went on the bond market from 120 to 105, and I think it's a little too much too soon. So, in my opinion, we're going to be hovering around here unless that data is really negative. So let's start looking for it, and we'll just keep updating this and seeing what happens. Now, a few encouraging aspects. The market had a huge selling day, and look at volatility. It barely moved. I mean, look at 5-day trend. This is it. Yesterday didn't really do anything. So it looks like volatility has assimilated this down move. As far as put to call ratio, look at where we're at right now, folks. We're at 118. We're really overdone, which is why I believe any downside in the market is going to be rather limited. And I really mean that, because that rubber band is really stretched out. I mean, really stretched out. Let's see. Let's keep flipping this till we get an actual number. I want to see what we get out of that. So coming back to the broad market, you're still, let's see here. Nope, not yet. Coming to the broad market. Let's see. Here's the broad market. You still have, over a month period, you still got energies, utilities, and consumer staples ahead of the pack. This is very encouraging, and I'm really liking this. But look at this. If you go to a 5-day, you start seeing consumer discretionary in there. That's really, really important, and that's really impressive. And that's telling us that the market may, in fact, be bottoming out. So again, this is a very, very important clue to where we stand, but I'd love to see what the retail sales data is telling us right now. Let's see here. Let's see. Well, we'll come back to it. In terms of sectors, let's see. Maybe it's done. No, not yet. All right. I love watching it in real time. Now, in terms of sectors, utilities, energy, healthcare, and look at consumer staples. This is the big question mark, and I'm a little confused about this because honestly, consumer discretionary shouldn't be up there. Now, the number's not out yet. I love playing with it in real time. So let's look a little bit at these sectors, and then we'll come back to the Econo report. So as you can see here, consumer staples, you've got a very, very small, a very, very low number above the 50-day moving average. And you look at real estate, you've got a really, really low number below the 50-day moving average. And as I predicted, a lot of the stocks here are starting to look like the stocks in the 200-day line. That means we're pretty close to bottoming out. I don't think we've got that much more to go. Oh, look at the numbers. The numbers are a little better than expected. Not on X vehicles and sales, but overall the headline is a little better than expected. I like this. And X vehicles and gas month over month, it's, let's see, consensus 0.6, a little lower, but I like the headline number. It'll be very interesting to see how the market responds to it. But all in all, the retail sales data was not that bad. Let's look at jobless numbers. Jobless numbers should be okay. They are not usually that bad. And while this is updating, we'll just kind of look at the stock market. We'll look at the sectors, and I want to show you how even here, look, you've got only 23, 24. They're starting to come in line. The momentum levels are a little bit overdone to the downside across the board. So the fact that NASDAQ is bottoming out on the number of stocks trading below the 200-day moving average, the fact that the put-to-call ratio is at 118, the fact that the bond market isn't really selling off. It's actually upticking based on this news, which I was expecting. So things are not looking as bad as they may appear. Now, we still have a lot of friction ahead of us, but things are assimilating. It appears to me that the market is starting to assimilate everything, and the fact that the put-to-call ratio is near the 118 level is telling us that there's still a lot more put buyers in comparison to call buyers. Typically, this is mean reverting, and it comes back here. So that's a really good sign for the market. Now, as far as levels to watch, let me give you some levels. All right, let's go here. For the S&P 500, I want us to not break below the 388 level, and I want us to see us rally above the 403 level. On the Dow, I want us to trade above the 30,900 level, and I want us to trade above the 32,260 level. That would be really, really, really good. And on the QQQ, what I would really love to see, let's see here, and nothing major here, 213,000, right in line. Let's look at manufacturing data. And on the NASDAQ, sorry, I'm jumping back and forth, but I assume you're going to rewind this video, go back and forth. But this is really important. There's a lot of data coming out right now. So on the Dow, on the NASDAQ, I don't want us to break below the 291 level. We're at 296. I'd love to see us go up to the 50-day moving average. That would be ideal. That would really, really be ideal. Now, because today's Thursday, what do I always do Thursday? I give you my top ETF and option pick. Well, guess what? I'm sticking with the energy sector. I think energy is going to come back up. And let me go ahead and give you my favorite. And I think it's coming right back up right now, actually, next couple of days. Let me give you the ticker symbols XLE. And I would go all the way to December. Got plenty of time there. And I would go with the 82 or 83 strike price. If you're going to do a spread, buy the 82, 83 and spread it against the 88 or 89. So you got the 83. how about this? 82 and 8 or 83, spread it against the 90. The 90 looks pretty good right here. That's probably the best way to deal with it. Let's see, consensus. Ooh, manufacturing is bad. Bad, 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 bad. Bad number. Very, very bad. Very, very bad number. Not good. That's very, very bad. So that may eat into the positive retail sales report. But overall, honestly, the response from the market to this data that we've seen so far, like the CPI, PPI, it hasn't been all that bad. I'm a little surprised that people are so surprised that the Fed wants to raise rates, maybe a full basis point or 3/4 of a point. But honestly, folks, we need to go to about 3.754 to cool things off before the end of the year. Now, before I let you go, this is the final day. This is the final day, folks. This is it. Over the last week, I've been telling you about one of my favorite algo strategies, the alpha rotation. Now, it's a time-tested strategy that's performed incredibly well over the last 5 years on live trade alerts. Plus, alpha rotation is an easy strategy to follow since it only holds a few sector ETFs at a time for 2 weeks. You rotate and repeat, rinse and repeat. You can trade options on the ETF if you're looking for more leverage. But we plan to close the order form down soon. When I say this is it, this is it. So I hate for you to miss out on an incredible deal. So at least click the link below to get all the details. It's backed by a full 100% money back guarantee. You don't want to miss out. If you already own alpha rotation, definitely let me know in the comments below. Post your comments below. I want to know if you've been benefiting from it. And start getting my alerts right now. And also, don't forget to sign up for my Telegram channel. And you know what? I changed the mouse cursor here to a different color. I promised somebody it's hard to read. I'll talk to you guys later. Bye, guys. Have a great day. Comments, feedback in the comments section in YouTube. Bye, guys. I'll see you soon. Have a great day. Keep an eye on today's market, especially the bond market. Bye.